When you're working, taxes tend to feel straightforward. You earn a paycheck, and that paycheck is generally taxed as ordinary income. End of story. But once you retire, things get more complicated. Your income is no longer coming from a single predictable source. Instead, it'll likely include Social Security, investment income, retirement account withdrawals, maybe equity compensation, and possibly even some part-time work or business income. And while all of these provide the cash flow that you need in retirement, suddenly you're faced with a different taxation structure that interacts with each other, where one income source can affect the taxation of another, and sometimes in subtle and unexpected ways. So, for example, taking a distribution from your IRA might increase the taxable portion of your Social Security or push long-term capital gains into a higher bracket, or cause you to pay higher Medicare premiums. So when we're looking at taxes in retirement, each source of income falls partially or entirely into one of two broad tax categories. You have ordinary income, and that's taxed at your regular marginal tax rates, just like wages would be, or IRA distributions, short-term capital gains, or interest. All of those would be ordinary income. And then you have preferential income. And those are taxed at lower long-term rates, which is typically 0%, 15%, or 20%. And that depends on all of your other income. Now then, in addition to these traditional taxes, there are some surcharges that really function as de facto taxes, costs that increases as income rises, even if they aren't called taxes by name. These are the Medicare IRMA surcharges, where higher income retirees pay more for Medicare Part B and D premiums. And the net investment income tax, we typically just call that NIT, which is a 3.8% surtax on investment income when your modified adjusted gross income exceeds $200,000 for a single person, or $250,000 if you're married filing jointly. So I want to take a closer look at the three most common sources of retirement income: tax-deferred accounts, Social Security, and taxable brokerage accounts. We want to look at how each is taxed and how they can influence the others. Then we'll explore a few basic planning steps that can make a meaningful difference in your overall tax burden. So first, we have traditional IRA and 401k withdrawals. So withdrawals from tax-deferred accounts like these are the most straightforward from a tax perspective, but they're also the most powerful in how they influence your overall tax situation. These distributions are taxed as ordinary income, just like a paycheck during your working years that would be subject to the federal income tax. There's no special tax rates or exclusions. Every dollar you withdraw increases your AGI by $1. So at first glance, this seems simple enough, right? But the ripple effects of how things affect other income sources are where things get more complicated. So first, we have Social Security. Adding taxable income from an IRA can increase your combined income, which may cause a larger portion of your Social Security benefits to become taxable. And in some cases, one additional dollar from your IRA can pull in another 85 cents of Social Security into the taxable column, and that creates what we generally call the tax torpedo. Then we have capital gains and dividends. So large IRA withdrawals can push you out of the 0% long-term capital gains bracket, causing you to pay 15 or maybe even 20% on what could have otherwise been tax-free. Then there's the Medicare premiums and the income-related monthly adjustment amount, or what's normally just referred to as IRMA. So higher income from IRA distributions can trigger Medicare IRMA surcharges, increasing your monthly premiums for Part B and Part D, and that has a 2-year lag. And then we have the net investment income. So for high-income retirees, and sometimes you don't necessarily have to be rich to have a high income. It could be from a capital gain, a big IRA distribution, or something like that. But IRA withdrawals are the most common culprit to subject you to the net investment income tax. And that pushes your modified adjusted gross income above the threshold where there's an additional 3.8% tax applied to your investment income, like your capital gains, interest income, and dividends. So while IRA withdrawals are easy to understand from a tax calculation standpoint, they are rarely isolated. They stack on top of all your other income, and they can unintentionally raise the tax cost of everything else. And that's why strategic withdrawal timing, carefully planning your Roth conversions, and income layering are so important when building a long-term strategy in retirement. And then we have Social Security benefits. So most retirees know that Social Security can be taxed, at least until the legislators decide that it cannot be. But what many don't realize is how interconnected the taxation is with everything else in your income stream. Now, the big number on taxation is that anywhere from 0% to 85% of your benefits could be included in your taxable income. And if they are, the portion that is taxed just like any other income at your ordinary marginal rate. Now, to figure this out, the IRS uses a formula called combined income. Now, combined income includes your adjusted gross income plus any non-taxable interest like municipal bond income plus half of your Social Security benefits. So you put those together, and that's your combined income. Then based on that number and your filing status, you fall into one of three brackets. If you're single and your combined income is under $25,000, none of your benefits are taxed. But if it's between $25,000 and $34,000, up to 50% could be drug into taxation. And if it's over $34,000, up to 85% could be taxable. Now, if you're married filing jointly, those numbers are slightly higher, where if your combined income is under $32,000, no benefits are taxed, but between $32,000 and $44,000, up to 50% becomes taxable. And for amounts above $44,000, 85% of your benefits become taxable. Now, let me be clear. This does not mean that you're paying 85% in taxes, right? I mean, that would be an astronomical tax rate. What it means is that up to 85% of your benefits get added to your taxable income and then taxed at your normal rate. Let me give you an example of why careful planning in this area really matters. So let's say a married couple filing jointly in 2025 each receives $30,000 in Social Security benefits. So that's a combined total of $60,000. And they also withdraw $50,000 from their traditional IRA to meet all of their spending needs. Now, at that income level, a portion of their Social Security is already taxable. But now let's imagine if they just take one additional dollar from their IRA, just one. They're going to raise their withdrawal amount to $50,001. Now, that extra dollar increases their taxable income by $1.85. Now, why? They took $1 out of their IRA, and yet now they have $1.85 added to their taxable income. And that's because that new dollar of ordinary income also pulls an additional 85 cents of Social Security into the taxable column. And that cascading effect is often referred to as the tax torpedo, where certain income levels trigger interactions that cause your effective marginal tax rate on new income to be far higher than your nominal tax bracket suggests. So if your income is in a certain tax range, you have to be careful about the spillover effects. And then we have taxable brokerage accounts. Now, I think these accounts are one of the most flexible tools in retirement planning. Unlike IRAs or 401ks, there are no penalties for withdrawals, no required minimum distributions, and no income limits. And just as important, they offer the potential for preferential tax treatment, especially when you hold investments long enough to qualify for the long-term capital gains. So income from taxable accounts can typically be a number of things, right? It can be short-term capital gains, it can be interest, it could be non-qualified dividends, and all of those would be taxed as ordinary income. But then you have qualified dividends or long-term capital gains, and those are taxed at either a 0, 15, or 20% rate, depending on your other taxable income. And this preferential treatment can make taxable accounts highly tax efficient, particularly in years when your other income is low enough to keep you in the 0% capital gains and dividends bracket. Now, the challenge comes when taxable account income is stacked on top of other income. So realizing large capital gains, for example, can increase the taxable portion of your Social Security benefits. It can push you into a higher capital gains rate. It can trigger the 3.8% net investment income tax, can lead to Medicare surcharges. So while these accounts are flexible, they can also create tax ripple effects if they're not coordinated with your broader income picture. So let me show you a real example here of a retirement tax domino effect and how one decision triggered a costly retirement chain reaction. So meet Susan. All right, she's 68. She's recently retired. She's in good health. And she and her husband are married, filing jointly, and they're living comfortably on $5,000 a month in Social Security benefits, which is $60,000 a year. Now, they also receive a bit of dividend and interest income from their taxable brokerage account. Now, their total taxable income is modest, and before any major moves, they only get taxed on 18.5% of their Social Security benefits. But earlier this year, they sold some stock at a $50,000 long-term capital gain. They thought that they'd still qualify for the 0% capital gains rate. Now, later in the year, their financial advisor suggested what seemed like a smart idea: convert $150,000 from Susan's IRA into a Roth IRA to take advantage of what looked like a relatively low tax year. But those moves set off a domino effect that they didn't see coming. The Roth conversion and capital gains raised their income dramatically. And as a result, they went from having to pay just 18.5% of their Social Security. Now it's being taxed at the maximum, 85%. That means an additional $32,100 in taxable income from the Social Security alone. And then they lost the 0% capital gains rate, and they'd already realized that $50,000 long-term capital gain, but now the Roth conversion pushed them well above the threshold, and so now that gain is taxed at 15%. And that alone adds $7,500 to their tax bill. But this also made them trigger Medicare IRMA surcharges. And so 2 years later, they receive a letter from Medicare, and because of their spike in income doing the Roth conversions, they're pushed into the second IRMA bracket. That means an extra $185 per month per person just for Medicare Part B. And that's based on current rates, which would likely be higher then. So that's $370 per month, or almost $4,500 per year in added premiums. And then they also owe the net investment income tax. The combination of capital gains, dividends, interest, and the large Roth conversion pushed their modified adjusted gross income over $250,000. And that subjects part of their investment income to the 3.8% net investment income tax. And that added another $800 to their tax bill. So what they thought would be about a $25,000 tax bill on the Roth conversion ended up driving their taxes up by another $7,500 in capital gains, $798 the net investment income tax, $6,500 from the taxation of Social Security, and another $4,400 from the increased Medicare cost. So what felt like a smart move, paying taxes now to reduce future RMDs, turned into a financial minefield. You know, the Roth conversion itself wasn't the problem. The problem was doing it without understanding how it would interact with everything else. So the Social Security, the capital gains, Medicare, and the investment income. And that's the retirement tax domino effect. And it's why smart tax moves need full coordination and not isolated decisions. You know, Susan's story really illustrates a key truth about retirement taxes. Nothing happens in isolation. A single financial decision, like a Roth conversion or capital gains realization, can create ripple effects throughout your entire tax picture. And that's why smart retirement tax planning is not just about understanding how each income source is taxed on its own. It's about managing how those income sources stack, interact, and then trigger those hidden thresholds. So here are 3 key takeaways from this. First, sequence matters. The order in which you draw from different accounts can dramatically affect your tax bill. So withdrawing from a taxable IRA might make sense one year, while relying on a taxable brokerage or Roth account could be better in the next. The goal is not just to minimize taxes in a single year, but to smooth your income over time and avoid spikes that push you into higher tax brackets or cause those additional surcharges. And then second, you need a multi-year plan. 1 year of tax savings is very helpful, but real value comes from planning across a timeline. A well-structured withdrawal strategy, especially in the years between retirement and the required minimum distributions, can reduce your total lifetime tax bill, can lower Medicare cost, and give you more flexibility in the years ahead. The bottom line is that retirement taxes are not just about percentages. They're about relationships between income sources, tax thresholds, and timing. And when you understand how these pieces fit together, you can turn a complex tax system into a powerful planning opportunity. And that's exactly why retirement planning can't be reduced to software alone. These tools are excellent at handling the complex math behind the calculations. Their real role, though, is really to serve as data builders, not decision makers. Even with perfectly entered data, it still takes experience and insight to connect the dots and understand the trade-offs and then make those decisions that truly align with your goal. And if you think we can help, I'd love to connect. We offer a free retirement clarity meeting, which is a one-on-one conversation with me personally. You'll leave with a clear picture of how we help people retire with purpose and peace of mind, and I'll also get to understand your goals, your concerns, and what matters most to you. And this isn't a sales call. There's no pressure. There's not going to be a pitch for some kind of product that we have to sell. It's just a real conversation to see if we're the right fit for your retirement journey. And you're going to find a link down in the description where you can book that directly on my calendar. Thanks for watching.